Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Another volatile week. I think I'm just going to record myself saying another volatile week and play it in every Bondcast episode. This week all been about US CPI. So let's start there, Jan. I think we finished off last week's Bondcast actually talking about the US, and we recorded it ahead of NFPs, but we talked about how we were looking for an above consensus print on NFPs and on US inflation. And that's why we like kind of paying the front end in US rates. As it happened, we actually got an even stronger than we expected, but certainly stronger than the market expected on both NFPs and inflation. What was the drivers around that kind of beat on both headline and core this month?
Discussing inflation, I feel like I'm having a deja vu now because, I feel like last time we recorded this right after inflation, it was, again, hard to find a silver lining. And it's even more so this time because inflation came above expectations, which are already pretty high. The Fed usually tends to ignore the headline portion, which is considered more volatile, and it has food and energy included in it. The average, consumer obviously does not. So the headline part came at 1.3% month on month, which brings the annualized rate to, the year-on-year rate up to 9.1%. This is like a historically high level of inflation, not all-time high, but certainly reaching very, very dangerous levels if we're already not there. And the core component also increased by 0.7, which is, again, on a monthly basis, that's well above what markets were expecting. So when we talk about what was driving inflation, when we took a little bit of a deeper dive into the subcomponents, it's just very, very hard to see anything that really moderated. The economy is shifting their spending from goods into services, but goods prices increased and so did services. So there was no really obvious trade-off as goods are kind of dragging down inflation. So you don't have this reversal, for example, in car prices and another form of durables that you might want to see at this point. So in summary, it's just really, really bad news for the Fed and probably for the economy, and of course for the pain the average consumer feels, because particularly things like what worries me are the more sticky components, such as in shelter. So you have rents, you have owner equivalence rent, which is like the imputed value of what you would rent your house out as an owner. And those things have been increasing by 0.7, 0.8, accelerating. And it's a well-established fact that, it's widely considered that these will be sticky. They'll kind of continue in a similar, I don't want to say fact with this because, a lot of facts have been kind of...
You're on the record now.
Yeah, a lot of things have turned out to be a strong hypotheticals. But it is hard to imagine a scenario where the price increase in rents just take a nosedive. They could slow down a little bit, but we're unlikely to go from 0.7 this month to 0% next month. So as these make a large portion of CPI, the pressures are still there and the Fed will have to react accordingly.
Okay, so let's pick up on that point then about the Fed. How important really is this? It's not just a strong inflation, a one-off strong inflation print. There's drivers in there that you expect to be sustained, at least in the near term. We obviously also had much stronger than expected labor market data on Friday. Does this really move the needle for the Fed? Markets were already pretty much there on expecting 75 basis points, and now we're talking about maybe 100 basis points. How do you feel about that?
It's hard to exactly say today that they're going to do that. Like you said, market is almost there, especially after a strong PPI today and some Fed speakers that came out saying nothing's off the table. And that's understandable. Our official call at the time of recording hasn't changed so far for 75, but we acknowledge that even if they do 75 in July, the odds for them to continue at the same pace are pretty high. So you could easily see a scenario where we get 75 in September. Of course, there's a lot of time from now until then. We're going to get 2 more inflation reports. We have Jackson Hole at the end of August, where a lot of these news are also communicated. But I think market pricing for 100 basis points is fair, maybe even possibly even overdone to a certain extent for me, in my mind. call it like 60, 70% at this point is a reasonable assumption that they're going to step it up again. We're about to hear from Governor Waller, who has been one of the trendsetters in the hawkish direction. So he could be the one who also, sends the message that the Fed will do. They're all in favor of front loading, so maybe let's do another more. So maybe we're going to start talking about hikes in percentages as opposed to basis points now. So, but yeah, I mean, if they do 100, I can easily see a scenario where funds end up at over 4% this year, and you just kind of have the curve continuing to invert and just for the Fed to completely abandon the soft landing rhetoric, just like they abandoned the transitory inflation rhetoric. And just finally, the one kind of thing that I could see being as a little bit of a hurdle, Chair Powell probably doesn't want to see too many dissents, and we already had one dissent last meeting for the 75 basis point hike. So I know things have changed, inflation has accelerated, but if people are dissenting at 75, then you could see more voices speaking up against overdoing it, potentially kind of forcing the economy into a recession, which might be the Fed's end goal, but this is not their official stance. And of course, everyone kind of wants to avoid that scenario. So that could be a hurdle. I don't think it would be enough to stop them from going that direction, but it's something to keep an eye out.
Okay, lots to watch for them for the next couple of days and weeks then.
That's an understatement, yeah.
I guess just bringing it back to markets then, you touched briefly on kind of where, market pricing and what you think about that. I think, if I'm not mistaken, that we spoke last week about how, you like paying front-end rates into this data that last week and this week. Markets, I think, were a little bit confused, particularly the initial print yesterday. I think they didn't really know whether to make this, read into this as like a near-term policy signal for the Fed and therefore price in increased chances of 100 basis points, or worry about what these kind of super high inflation prints mean for growth further down the line. And they were kind of grappling with those two themes. It seems today, and we're recording this on Thursday for any listeners, but it seems today like they've settled in the higher near-term inflation story, particularly at the front end. So how does that leave your view on front-end rates? Because that was probably your higher conviction view heading into this week.
Yeah, and I think the conviction is still there. If anything, it is kind of more reinforced now, because something interesting that we saw on the back of the inflation report, like you mentioned, markets are a little bit confused, and we saw repricing higher of front-end yields. But what we also saw was an earlier inversion of the futures curve. So until yesterday, markets were pricing in cuts, or at least like mechanically peaking rates near April and May, and now we've pulled that to February. So if you kind of look at the futures contracts, you see rates starting to decline from expected rates starting to decline from February onwards. So I think that's wrong. I just can't see a scenario where the Fed, even if they see a deceleration towards the end of the year, they kind of decide to take their ease off from the tightening, or even go in direction of cuts. So I think that will be the next leg of what drives the front end yields higher. So we didn't only think that front end yields would go higher. We also had a view that there was too much of an inversion that had to fix itself in more kind of like markets terms. The expression was through like a 1 year forward. And that's worked out well, because in our view, markets have to accept that the Fed is just not going to back out of this, even if we see inflation slowing down, even if we disregard the fate mandate. It's just hard to me to imagine a scenario where they declare a victory so early into next year, and until they see this thing through, because just this hypothetical scenario where let's say rents are declining, you see like 0.5, 0.4, and then could you just assume that it's going to continue like that? Or because the Fed's basically said they're not really confident relying on their economic forecast given the pandemic. So I think they're going to want to see realized numbers actually coming solidly well below target before they can actually say, we won this, let's take a victory lap and start cutting or even maintaining. I think that's what drives the next leg higher in kind of like very front end steepening of the curve, and seeing things like 1 year in our case going up to mid threes probably.
Okay. Yeah. A lot to watch then. I think I just said that, but I feel like there's even more to watch now. Okay, let's switch over to Europe then, because it hasn't been a quiet week there either. But away from, I guess, global data, one of the major fears around market sentiment in Europe this week has been around, or one of the major drivers, sorry, of market sentiment has been around the fears related to the gas supply and what happens if Nord Stream is not switched back on again after this maintenance period. Now, actually, if you look at, we were just talking off the desk earlier, if you look at the level of, say, 10-year bunds, they kind of mask, I think, the volatility that we've had intraday and during this week, because actually overall we haven't traveled that far, but there has been a lot of volatility surrounding this story. So are market concerns valid? Have they taken it too far? How are you thinking about this as a theme, Giles?
Okay, well, the first part of your question, is it valid? Yes, clearly it is. There is a lot of concern. First, I mean, to be honest with you, it was flagged by very serious people in European government as a risk. And this is something I think which everybody has been taking seriously for weeks now. I guess that markets have more or less clearly they've caught up with it by now. I think it was really last week that they were really turning their focus to this as a risk. The question of whether it's reflected in the market or not, I would say no. And I understand, of course, that there is confusion because on the one hand, it's inflationary, and on the other hand, it is a potential downside growth risk. And the markets have for a couple of months now really been looking for to put sort of more weight on downside growth risks globally and focusing more on that than on the inflation risks. I don't think that's right. I think that if this materializes, whether it's this or whether it's some other significant shock on the energy side, I mean, it doesn't have to be this, of course. This is something that's going to be likely to be hanging over us in one way or another for most of the rest of the year, to be honest with you. Russia has lots of ways, I suppose, that it can kind of turn the screw if it wants. I think it increases inflation risks, of course. And as I think we have seen in the US, we've just been discussing it, there is, I think, maybe an increasing realization that perhaps there is a higher inflation sort of equilibrium where higher prices across the board sort of self-reinforce and so on. And we just haven't really been fully prepared for the extent to which that could develop. So that I think, although under the hood, what's driving inflation is a little bit different in Europe and the US. I think when it comes down to the basic question of can this become self-reinforcing, I think it can become. And I think it also brings in fiscal risks into play in Europe. Now, we've seen a little bit of sort of, I guess, effort by governments to give back a little bit to consumers who are obviously hurting because of this cost of living crisis. But I think that the pressure to do a lot more would be very difficult for them to ignore if it weren't, because up until now, that's been sort of counterbalanced a little bit by reasonably strong labour markets and so on. So I think that would just intensify. All of which means you're very likely to end up in a very difficult environment for the ECB to accommodate. If you look at what markets have done, I mean, you're saying, Imogen, that bunds have sort of done a big round trip, but if you don't have to go back all that much further to see that compared to the peak, the recent peak in sort of 2-year rates, for example, we've rallied 50-60 basis points. Right. So that doesn't suggest that this is a market that thinks that the ECB is going to be under pressure to do more. It's a market that thinks the opposite. And I don't think that's right. And the final point is, what does this mean around Europe? Because it's quite an asymmetric risk, right? It's clearly more of a risk for Eastern Europe and Germany, much less of a risk for France, Iberia, even to a certain extent, Italy, actually. And, markets have been seeming to want to trade this from a sort of traditional, it's just risk off, therefore I'm going to have bunds, thanks very much. And I don't think that works there either.
Okay, there's two things you mentioned there that I want to pick up on. So I'm going to start with Italy and then we'll come back to the ECB, because of course this isn't the only, although, very much intertwined with what has been going on in Italy on the political front, is that although this in and of itself isn't necessarily a huge issue for BTPs or for Italy, they're now kind of entering potentially a political crisis. Now, I should warn listeners, as I said, we're recording this on Thursday. Literally as we speak, Draghi is meeting with Mattarella. So I'm giving Giles a very short time frame to be proved right or wrong on what he's about to say. But how important, I guess, do you think this kind of latest political drama in Italy really is? Are we heading to early elections very soon? Are markets pricing that in? Should BTP bund spreads be much wider, or can the ECB just come to the rescue with an anti-fragmentation tool? What's your latest thoughts on that, all of that?
Okay, so I'm going to try to keep this a relatively short answer because, as you say, by the time many people listen to this, they'll probably have a lot more information than I do. But I think it clearly is an asymmetric risk. I mean, maybe your base case is that Draghi, the market's base case, I'm sure at the moment, is that Draghi probably survives, maybe after offering his resignation, being asked to come back. But there is definitely a risk that we end up in the coming days with another prime minister, someone like Amato or Franco or someone like that, respected figures, but with less political clout, perhaps. Now, I don't want to overplay that, but certainly less market clout. Okay, and I think that's really the key point for us. Now, maybe there's a route over the longer term to new elections. Against that, maybe there's a route to Draghi becoming president, further down the line. But overall, I think that if we're entering a difficult period for Europe and Italy, the perspective of doing that without Draghi at the helm of the government for Italy, it's not going to be an easy environment for BTPs. So I'm a little bit bearish BTPs at this point, not dramatically, because as you say, the ECB is there in the background, and I think that it will resist a significant widening. By significant, maybe I mean sort of 20, 30 basis points at this point. So, I don't think that we need to over dramatize, but it's a challenging environment.
Okay, let's round up the discussion on Europe then with the ECB, because obviously that is super relevant both for Italy and, everything else. They meet next week. This is obviously the July meeting, which is widely anticipated to be the meeting where they will hike rates for the first time in a very long time. First time I've ever seen an ECB rate hike. Very exciting. They've kind of tied their hands a little bit to doing 25 basis points. Is that what they deliver? Is that the right thing, do you think, for them to deliver? And then, what else do we learn? I guess markets, particularly in the context of everything that's happened this week, will be closely watching any news on this anti-fragmentation tool. Do you have high hopes for that?
Okay, so expectations for the ECB then. Yes, clearly the first rate hike in your professional life, Imogen. 25 basis point move. I think everyone expects that. It's very difficult to see them doing anything else, given they've told us what they're going to do. Plus a signal for a larger step, which I think we all assume will be 50 basis points and not more at this stage. So I don't think that there's any great mystery about all of that. The main question, of course, is OMT2 or whatever you want to call it, this anti-fragmentation tool. So what do we think about that? Well, I think it's a bit better than 50-50 that they come out with an actual announcement in July. They set themselves a pretty tight timeline. They said that they'd accelerate it. They would clearly, ideally, they would deliver it now. But I think as long as they talk in the right way about it, it can possibly be pushed. I mean, we all understand that it's a difficult thing to get right, and there's a lot of, even on the legal side, there's, it's not just a Hawks versus Dove question, right? I mean, you have to make sure you cross your T's and dot your I's to make sure that there's no comeback on this on the legal side as well. So, but anyway, the main questions about that are conditionality. Clearly there needs to be some. We think it has to be light. It has to be the kind of conditionality that ideally countries don't actually have to ask for. So probably something along the lines of what we already have for the recovery fund, maybe with strengthened in various ways. But I think that is probably where markets already are. We all understand that. Size, is it going to be limited? Is it going to be unlimited? I think it needs to be unlimited. I think that they'll probably deliver something that is unlimited. There's a potential disappointment there if they set a limit, particularly if it's too low, obviously. Questions about reporting. And I think that they will report on what they're doing, probably along the lines of what they did with the PEPP, maybe something, obviously we'll have a line in the, obviously, I expect we'll have a line in the financial statement weekly, but with some details, perhaps bi-monthly or something like that. Will it be sterilized? Yes. So obviously the big question that we've been getting is, okay, right, given all of this, what would actually constitute a disappointment and therefore a downside risk for spreads in next week's meeting? And well, I've already mentioned one, possible to too tight size limit. Anything about conditionality that actually sets up kind of stigma risks around asking for this to actually be triggered, or perhaps the involvement of the European Council or something in a context which might require consensus or something like that, which might be hard to understand at least.
Yeah. But
those are the main elements for next week's meeting, I think. So that's all I want to say about the ECB. And I want to turn it back on you now, Imogen, because we need to talk about the UK. Plenty of things going on there. It's not just been about the US CPI that's been surprising this week. We also had some pretty strong GDP numbers out of the UK, and I wonder what you are saying about that in the context of what does that mean for the Bank of England, for example?
Yeah, so we got the May monthly data this week for the UK, and that surprised significantly to the upside, just like the US CPI did. So that came in at growth in May of plus 0.5%. There was a huge amount of kind of media hype. The markets were quick to assume that we can price out any chance of recession. The UK economy is growing much stronger than we expected, and very quick to increase the chances that this implied that the Bank of England would be hiking by 50 basis points in August. But actually, if you drill down into the detail, and it took us a while to do so because the ONS language around this was actually a bit ambiguous, perhaps deliberately, but it really feels like this was actually all due to the bank holiday adjustment. So we actually had one less bank holiday in May than we would usually expect, and that was moved to the June for the Queen's Jubilee weekend, and therefore to the extent that the monthly print in May was much stronger than expected, it just creates more of a drag for the June data. So actually we now forecast the monthly print in June to show a contraction of more than 1%, which leaves your Q2 number negative. And I think that anyone that thought that this was kind of the kicker to the Bank of England locking in a 50 basis point hike is reading it wrong. And that is not the implication at all. I'm not saying there's no chance that the Bank of England go 50 basis points in August. It's not our base case. Our base case is they do 25. But if they do, it's not going to be driven by this GDP data. They will have all the details that we have and know that this is a bank holiday driven effect and is really just kind of a falsity, really, if that's even a word. A distortion is what I was looking for in the data, and it's not at all anywhere near as important as markets have made it out to be.
Okay, the other thing that's been going on in the UK, of course, is the political drama that's unfolding. A lot of parallels have been discussed between the UK and Italy this week. Not all favourable for the UK, but perhaps you could just explain to listeners what you think that all means for markets, because there are some implications, of course.
Yeah, well, there are, but I would say that markets aren't reacting in a particularly aggressive way to any of the political noise. And I think that there's probably two reasons for that. The first is that, well, as I keep saying, we're recording this on Thursday, and the race to be the leader of the Conservative Party and therefore the next Prime Minister still seems pretty open at the moment. There's 5 candidates now that are still in the running. We've just heard the news that Suella Braverman has dropped out in the second, well, not dropped out, but she's been forced out or eliminated in the second round of votes, and they won't vote again now until Monday. So that still leaves 5 candidates in the running. So it's a fairly open race still, and no huge amount of conviction of who the winner will be, although, bookie favourite and a lot of polling odds put Penny Mordaunt in a strong first position. And also, I just think there's so much else going on globally that is probably more important than this. US CPI, everything that's happening in Europe around the gas supplies, everything we've talked about on this podcast, I think has just been more of a driver of markets. So the UK this week, despite the data yesterday, it feels like it's kind of taken a bit of a backseat. And so although there is a lot to talk about, almost, it feels like it's not been a huge driver of market sentiment. But yeah, so like I said, we've now had the second round of votes. Suella Braverman has been knocked out. We've left to the final 5. They will now go to a third round of voting on Monday. And if necessary, a 4th round will take place on Tuesday. So hopefully by next week, when we catch up, we'll have a little bit more clarity. But as it stands, I guess the market conclusions really are not that different to the ones that we made on the podcast last week, just that we feel that the chances of earlier elections are probably slightly higher than they were before. At the margin, this increases the likelihood of earlier and larger fiscal stimulus. A huge kind of portion of the debate between the candidates at the moment is focused on tax cuts, either for corporations or on personal income tax, and not a huge amount of how that is going to be funded, but clearly that's a focus of the campaign. And even if we don't get to earlier elections, they're planned anyway for spring 2024. So we were already heading into a pre-election year in 2023, and I think given how much the cost of living crisis is likely to bite in the second half of this year, and the fact that elections tend to be associated with kind of fiscal giveaways, I think that can be your kind of strong base case heading into the end of the year in UK rates. So some upward pressure, I think, over the kind of longer term is probably warranted, but it's certainly not the news that the market is trading on really today, and I'm not sure that it will next week, even as we kind of narrow down in terms of the likely candidates.
Okay, and finally, for all of those who really enjoy the nitty-gritty and have managed to make it to the end of this podcast, perhaps you can just give us a quick rundown of the technical thing theme of the week, which is lots and lots of coupons being paid, index events, and so on. And what does all of that mean for the gilt market?
Yeah, we certainly saved the best till last.
I was going to say last but least, but it but it is important, and we are masters of the detail as well as of the macro. So
exactly. No, it is
Go
important.
ahead.
And given everything I just said about the UK, in some ways, this could well be an important driving force over the next couple of days. As you said, we get a whole host of coupons paid next week, and then a little bit more the week after as well. And there's also a July 22 bond redeeming next week. And that's an important event because it's the second bond to mature since the Bank of England have stopped reinvesting the proceeds of its QE program. So I guess officially kind of QT in terms of letting the balance sheet run down. But this is a bond that they don't hold very much of. So they held a huge proportion of the bond that matured back in March, something close to 70%. And they hold about 10% of this bond. So there's a lot of money kind of held by private investors that will have to be reinvested, which I think should, generally provide support for probably mostly the 5-year sector. But we also then have these coupons being paid, and a lot of these coupon flows are coming from long dated bonds. So I can see support for the long end of the curve. So it's broadly a supportive story, I think, for gilts as a whole over the next couple of days and weeks. I think that the cash flows can be supported. And for those that are kind of, heavily involved in the gilt market and obviously know about this, I think that may well dominate actually the kind of political events over the next couple of days. So not the most exciting topic, but perhaps a little bit more important for those that are interested.
Okay. Well, thanks very much, Imogen. And shall I go for it? I think that's all we have time for today. So thank you very much, everybody, for listening this week. And if you have enjoyed today's episode, please hit the like button and also subscribe so that you can get the latest episodes as soon as they're available.